Well, it's official. Average 30-year fixed rate mortgage rates increased to the highest levels since October of 2000, officially a 23-year high regarding average rates according to the Mortgage News Daily. So what happened today? I'm going to share that, but also going to share some implications of our U.S. housing market as well here, because of course, rising rates impacts home buying demand, which of course impacts the housing market in general here. So here's what happened to the 10-year. Here's the note on that at 4.786%, up by 7 basis points compared to yesterday. Excluding one day, which was on Monday, this is the highest levels going back to the year of 2007. So what happened here? Average rates, according to the Mortgage News Daily, I just can't get over this. According to the Mortgage News Daily, 7.84%. Again, for people with great credit buying their primary residence. And just absolutely insane. 7.84%, the highest level since mid-October of 2000, officially a 23-year high. Jumbo rates is at 7.9%, and FHA and VA loans is around 7.25%. When looking at rates 12 months ago, we're looking at a rate at 7.04%. That's an increase of 0.8 percentage points over the past 1 year. When we zoom out over the past, 23 years here, this is according to Freddie Mac, because the Mortgage News Daily only goes back to, I believe it was 2009. So at 7.84% right now, the highest level since October 13th, 2000. And also just doing a quick Google search of rates today. Right now in California, putting 20% down, your FICO score in the range of 740 to 759, an average mortgage rate at 8.1%. Absolutely insane. I just can't go over this. Also, according to Investopedia.com, they're looking at a rate of 8.14%. The rates on Investopedia.com tend to be a little bit higher compared to the Mortgage News Daily, because they're looking at a wider range of FICO scores. So let me just actually share that with you right now. So they're looking at FICO score in the range of 700 to 760. So the Mortgage News Daily looks at a rate, I believe it's actually over 740. That's why the rates on Investopedia.com tend to be a little bit higher compared to the other websites here. Also look at this, because for people doing a refi right now, you're looking at about 8.5% versus for a purchase, 8.14%. So what happened today? Here's what happened. This is according to the National Association of Home Builders here, or the NAHB. We had a strong jobs report for the month of September, just announced on Friday here. It says total non-farm payroll increased by 336,000 in September, following a gain of 227,000 in August. The estimates for the previous 2 months were also revised up as well. So for the month of July, it actually got revised upward by 79,000. It went from 157,000 up to 236,000. Also in August, it was also revised up, an increase of 40,000. They also say here, despite restrictive monetary policy by the Fed, nearly 5.9 million jobs have been created ever since March of 2022. That's when the Fed started increasing rates or increasing the federal funds rate. Also, in the first 9 months of 2023, nearly 2.3 million jobs were created, and the monthly employment growth averaged 260,000 per month compared to the monthly average in 2022 at 399,000. Also, if you guys are curious regarding the construction sector here, employment in overall construction increased by 11,000 in September, following a gain of 36,000 that we saw in August. Just absolutely crazy, this report here. If you guys are curious as well, for other sectors here, the biggest increase, shocker here, was leisure and hospitality, increasing by 96,000 jobs for the month of September. Government added 73,000 jobs, and healthcare and social assistance saw a gain of nearly 66,000. According to CNBC here, it says non-farm payrolls increased by 336,000 in September, while economists were projecting or expecting only a gain of 170,000. So well above the forecast, coming in at over 300,000 jobs added. Also, the unemployment rate, though, was steady at 3.8%, but still slightly higher than the estimate. Now, here's where it's not as bad as it could be, though, because wage growth only increased very slightly and came actually below the forecast. So just big picture here, the Fed wants to see the labor market slow down in order to decrease the amount of people who are paying for goods and services, because when people get a lot of income and get a lot of money, of course, that causes people to spend that money, which of course rises inflation. The number one goal by the Fed is that they want to decrease inflation, so they want to see job market slow down. This report here on Friday is telling us just the opposite, though. However, though, we're not seeing wage growth spiraling because wage growth came in slightly lower than was expected here. It says average hourly earnings rose by 0.2% on the month and increased by 4.2% on an annualized basis. The expectation, though, was a gain of 0.3% and also a gain of 4.3% year over year. And as a note right here, Friday's jobs report is one of the main reports that the Fed looks at in order to gauge future rate decisions by the Fed. Fed officials appear to widely expect rates to stay higher for longer. So in regards to that, let's have a look at the CME Fed Watch tool. This is the likelihood that the Fed will change the federal target rate or the federal funds rate in their upcoming meetings by the FOMC. The next meeting is in 26 days, which is on November 1st. Now, here's some big change here because they were expecting yesterday a much higher probability of a pause by the Fed in their next meeting, which again is on November 1st. It actually says it right below here. Yesterday, the likelihood of a pause was a 79.9% probability. Now it has decreased to 70.7%. In regards to another rate hike, the probability right now is at 29%. Yesterday, though, it was at 20%. So because the jobs market the jobs report came in much hotter than expected, the expectations of a future rate hike got actually revised upward here. But still, they're still forecasting a 70% probability that the Fed will pause rate hikes in their next meeting. This similar scenario also occurred for the probability for December 13th, because yesterday it was a 67% probability of a pause by the Fed, and now it decreased to 57%. Also, the probability of a rate hike in their meeting in December, it increased from 29.8%. Now it's at 37.6%. So overall, the street is expecting the Fed to pause any rate hikes this year, but the odds just got actually a little bit more narrow here. When I zoom out, going back to June 12th, 2024, it's virtually split whether or not the Fed is actually going to be cutting rates or keeping rates the same at 5.5%. Then in our next meeting, which is July 31st, 2024, by a 34.6% probability, they're expecting the Fed to pivot and also to decrease rates by 25 basis points. Of course, a lot could change because there's going to be a lot of upcoming data up until then. More importantly, regarding the CPI report, the CPI report is announced next week, which is going to be a very closely very closely watched report by the Fed here. So we could see big increases or big changes regarding mortgage rates given that report, which again is announced next week here. So here's an announcement from the National Association of Realtors regarding this September jobs report here. It says a job market continues to crank out jobs in high figures, again at 336 million or 336,000, I should say. It does not mean all is well, though. The jobs data, however, is considered a lagging indicator, as the firms will only make a job cut decision after having cut costs in other areas. Commercial real estate, though, is flashing warning signs. Net leasing on retail and warehouse spaces is slowing. The office sector is continuing to bleed with rising vacancy rates as well. Community banks, many with exposures to commercial real estate, are watching their balance sheets very, very closely. The fast rising interest rates are breaking several sectors of the economy. The remaining sectors will also likely crack if the rate hikes continue. Given that the inflation rate is already cooling, the Fed needs to stop raising rates and strongly consider cutting interest rates next year. That would be a soft landing without the net job cuts of the economy. I get what he's saying here, but my counter to him here is that if the Fed were to pivot sooner than expected, that could reignite inflation. In other words, cause inflation to start increasing once again, which will cause the Fed to start increasing rates once again. We don't want to see that. So the Fed's main target right now is to decrease inflation. If they were to stop future rate hikes and strongly consider cutting interest rates next year, that could cause even a bigger problem regarding inflation, but also our US housing market as well. I've been talking about this on the channel for quite some time. We have, multi-decade highs or multi-decade lows of housing affordability, a giant issue because rates and prices are so high right now, historically speaking. So if the Fed were to start decreasing rates, that would cause mortgage rates to decrease as well, which would fuel home buying demand, which again will cause this huge issue regarding increases in home prices as well. But that's just my takeaway from this quote here. Please make a comment below with your thoughts regarding this report from the September jobs market and also the reaction from the National Association of Realtors Chief Economist Lawrence Yun. Thank you so much for watching today's video. I appreciate you, and we'll see you on the next video.